The one who wants to borrow may not know who he should go to.
No.
So these banks are serving as the intermediaries.
Okay.
Whereby they take the surplus here and they give it out.
All right.
Yes. And like we know in our conventional banking, what they do currently is they, in one way or the other, try to pool funds from the community and give it out to the needy. I mean, to those who really need it for their business. But they do it at interest.
Okay.
Yes, they do it at a particular interest. It can be fixed or it can be floating.
Yeah.
And
in other words, they do so as if they render the service, but the end is that they want to make profit. Is that what they intend?
Definitely.
All right.
Definitely, they do it in such a way that they are helping, but then at the same way they're also trying to make profit.
All right.
Because in the conventional banking, what happens is you take the loan. I mean, you encourage people to come for loan. When they come for loan, you set some kind of floating kind of rate, and then from that floating rate, they also gain their objective.
Right.
They have their profit and they have everything from there. That's basically what the banking is about. And we also have finance.
Right.
In finance, let's say when someone wants to own a house or someone wants to own a car, like this mortgage and other things, you may not be able to start it yourself and just finish it just like that. At one point in time, you may need some kind of assistance from someone.
All right.
All right. So this kind of assistance that you may need, the banks also serve as intermediaries in this case between the person and the developer.
All right.
To assist you, to just finance you, to help you.
Okay.
Not only in owning a house or in owning a car, even in business.
Okay.
Yes, you want to gain some cash to assist you in your own business. The banks can help you, can help finance you.
All right.
I mean, can help you, yes, propel
towards the attainment of your objective or your project or whatever you want to do.
Exactly. But this also, we should not also forget that you take it together with interest.
Okay.
You have to pay the interest rate. It can be, currently I heard even this morning, that is 30%.
Up to 30%? I mean,
it's up to 30%, yes. So this is actually what the conventional banking and finance is about.
System. Okay.
Yes.
Thank you so much. I think this one now sets the pace for us to delve more into the Islamic dimension of our discussion.
Yes.
Islam has within its objectives the protection of wealth, and indeed, in fact, creating a base for wealth creation so that people will be able to make money, be able to pay zakat and build charity and so on and so forth. Yeah. But we would have been sufficient with the conventional one, but now the Islamic one has come into place.
Yes.
What is it that differentiate the Islamic banking and financial system from the conventional? Or are there some advantages that we can see? Are there some defects that we can see in the conventional one that makes it different from the Islamic one?
Yes. Yeah. Yes, there are actually a lot of differences.
No.
Well, in the first place, when we look at the conventional banking, what happens is there is something we call debt-based and equity-based.
All right.
What is the meaning of these terms?
Okay.
In equity-based, what it means is whenever the bank gives you something, the bank makes sure you own the thing, you own the equity itself. Whatever transaction that goes on, there is some kind of add value or value added in the system, in the community, in the society. And even before you gain something, you must take some risk. Like I said some time ago, al-ghurm bil-ghurm wal-kharaj bil-daman. Kharaj bil-daman, that is you gain profit out of risk. So the conventional banking is debt-based in the sense that people are encouraged to go for debt. Because anytime you go for the debt, you pay interest.
So they
also gain.
All right.
Yes. But then when you go for the interest and you make losses, that no one cares about it. It's at your own cost.
Yeah, it's at your own cost. Yeah.
But then if you go and you make hundreds or thousands of whatever, you only need to pay that portion of the interest rate.
All right.
So let's look at it in this way from the conventional banking. If you take it and suddenly something happens, all the risk is brought on you. And let's say someone is rich, the person has surplus, savings, and he just put the money there. He's going in on his business. This money is given to someone, maybe a poor person, as some kind of financing or a loan just to help the person, assist him. This kind of money that the person is given, the person has to pay some interest.
Yes.
So this rich person, although he's put his money, he doesn't care whatever loss you make, but all he cares about is whether rain or shine, you should pay him that interest rate, that portion, the addition on top of his capital. This kind of thing is the inverse